So good morning, friends. We'll just start about in a minute from now. So meanwhile, I would like you all to sit back, relax, so that we can get started. I'm hoping for some more members to join in. They just called up saying that they will need a few more minutes, but we'll start at 11:30 sharp as committed. So let's get going. Good morning to participants from the UAE. Very good afternoon to participants from India and Singapore. Ladies and gentlemen, welcome to the first one of our Leadership Insight webinars we have for business leaders, CEOs like you all today. We have switched off the video and muted the mic so that all of us can hear well. However, please feel free to share your questions or comments through the chat box. We'll certainly have them responded to towards the end of the webinar. Let's begin by saying that the coronavirus crisis is a story with an unclear ending. We're all witnessing its impact on the global economy today. The months ahead will probably be quite volatile and dynamic. We have an imperative today as business leaders to protect our employees and address business challenges and risks that's facing us today. Responding to COVID-19, I think we all need to define scenarios tailored to the company's context. We need to define the scenarios to stabilize the organization in each of these moves that we could take from a cash flow, P&L, and a balance sheet perspective. Today, our focus is on breakthrough, strategies on cost optimization that we can implement in our organization. I think some of us have already gotten to know Dr. Anil Lamba through his best-selling books, Romancing the Balance Sheet, Eye on the Bottom Line, and many more. Dr. Anil Lamba's passion has been spreading financial literacy globally. Dr. Anil Lamba believes that an organization can do wonders if all of its employees know the impact of their decisions or behavior on the bottom line. It is my great pleasure to introduce somebody whom I admire and respect, Dr. Anil Lamba, to all of you all here today. So Dr. Lamba will share with us his strategies on cost management in uncertain times like that we have today. Like I said, I would like you all to sit back, be comfortable, and prepare to be stimulated. Over to Dr. Anil. Thank you.
Good morning, everybody. Thank you so much, Hari. Always a pleasure to come and do any activity with you. We have enjoyed ourselves in the past. Look forward to many more in the future. Guys, in the chat box, just let me know, am I audible? Can you hear me clearly? So I can start off. Can I get some answers? Wonderful, wonderful. Thank you, thank you, thank you, everyone. I'll just share my screen so that we can have the presentation. Also tell me, is the screen visible? Yeah, is the screen visible? Sunil, thank you so much. Kind of you to say so. Okay, okay. So folks, topic chosen for today is breakthrough cost management strategies for difficult times. My problem always is each time I'm asked to speak on anything on finance, whatever time you give me, I find it short because the subject is so vast, and the more you learn, the more there is to learn. And today there's just about 1 hour. So I'm going to get right down to the topic on hand without further ado. So folks, my experience is, you ask a business owner, you ask a reasonably senior person in a company, do you know your organization's top line? You ask this question today morning, this person will give you the number up to last evening. Sales-driven organizations monitor top lines on an online basis. I'm sure most of you sitting over here would also be aware of your company's top line. You ask a senior person, do you know your company's top line? The person says, yes. You ask the same person, do you also know your bottom line? Bottom line is usually a black hole. So much so that sometimes business owners don't even know whether the organization has made a profit or a loss till the accounts department submits that information. This I find scary. Are we in business to generate top lines, or are we in business to generate bottom lines? Answer is business is all about bottom line. Without top line, there can't be a bottom line. So not underestimating the importance of top line. But when I emphasize on the bottom line, what I mean is we are not here to generate just about any kind of sales. The sales that you bring has to be such, the terms on which you sell have to be such, the period of credit offered has to be such, which eventually results in a healthy bottom line. And top line, you're constantly aware of, bottom line, you are clueless. I feel you should have tools and techniques at your disposal, whereby looking at the top line, you should have an idea of the bottom line. Now, I'm not sure whether in 1 hour I'll be able to give you those tools or techniques or not, but I'm going to discuss about those things. Because accounts department will give you this information much, much, much later. But folks, tell me, historical data you always have. Historical, you know both top line and bottom line. Let's say last year, your sales happened to be 100. And last year, your profit happened to be 20. This is history. Current year, you're monitoring top lines. And your top line has become 200. Can you guess the bottom line? What was the sale last year? 100. Profit last year, 20. Sale this year, 200. Bottom line? I'll give you 3 options. Do you think it can become 40? Or can it become more than 40? Or can it become less than 40? Which school of thought are you? 50, more than 40, more than 40, more than 40. Almost everybody's answer is more than 40. I completely agree with you. Folks, if your sales of 100 becomes 200, and if your profit of 20 becomes less than 40, I think some head should roll. Some people should not be around. Somebody is bungling up badly. You know, guys, somebody's hand has moved and that scratches have come. If you can also undo that, that will help, because otherwise these scratches will remain throughout the session and that will be quite an irritant. Can you guys see those scratches on the screen? Okay. So I am right now in agreement. Thank you. Thank you. One scratch is gone. The other one. Wonderful. Thank you. So I am right now in agreement with those of you who said if 100 becomes 200, 20 can become more than 40. To those, I have another question now. If you say it can become more than 40, how much more? Do you think if 100 becomes 200, it is possible for 20 to become 60? And in case you say it is possible, my next question would have been, do you think it can become 80? And if you say 80 is possible, my next question would be, is 100 possible? And I have space for one more column, is 120 possible? And the answer is, folks, if sales of 100 becomes 200, profit of 20 can become 40. It can also become 60. Even 80 is possible. Even 100 is possible. Even 120 is possible. Beyond 120 is not possible. I'll soon give you the logic. It's very, very simple logic. But before I do that, I want to ask you, out of those 5 columns given to you, right hand side, 2 of them are theoretical, 3 are practical. 2 are remote possibilities, 3 are in the realm of reality. Which 2 are remote possibilities, folks? Can you see some answers? And the answer is, you give me 3, Muthu Krishna. 100 and 120, no. 40 and 60, no. Answer is, if 100 becomes 200, 20 becoming 40, and 20 becoming 120 is possible in theory. The reality is going to be squeezed in between these two extremes. Now I'll give you the logic, very, very simple logic, folks. The moment I told you my sales is 100 and my cost is 80, what I have effectively told you, sorry, my profit is 20, what I've effectively told you is that my cost is 80. Now tell me, when sales of 100 becomes 200, when will profit of 20 become 40? That will only happen provided my cost of 80 becomes 160. That will not happen. If sales will double, every cost will not double. Similarly, when 100 becomes 200, when will 20 become 120? That will only happen provided my cost of 80 continues to remain 80. That will also not happen. Neither will all costs double, nor will no costs double, and therefore the reality has to be squeezed between these two extremes. Now tell me, that first column information, where did I get it from? I must have obviously extracted that information from a financial statement called P&L, where that figure on the left, on the sales figure, must have appeared over here, 100. And the cost of 80 must have been the sum total of the left-hand side of the P&L, which must have included items like raw materials and power and salaries and commissions and rent and many, many, many more items. And the total of this must have been 80 and the profit is 20. This I have condensed and given to you in column number 1. And what question did I ask you? Question asked of you was, what will happen if my sales of 100 becomes 200? Tell me, if sales of 100 becomes 200, what is the possibility that for 100 sales I was consuming raw material of 45? What is the possibility for 200 I will consume 90 strong? For 100 sales, my power consumption was 5. If I sell 200, can power consumption go up to 10? Can. When my sales was 100, my salary bill used to be 9. Because I sell 200, will I pay my employees 18? No. Maybe 10, 11, 12. Or if this data was not for year 1, year 2, if it was for month 1 and month 2, then probably 9 could also have remained 9. Similarly, when people who brought me business worth 100, I gave them a commission of 10. If they bring me business worth 200, will I pay them 20? Answer is yes. Commission, like brokerage, is proportionate. And when my sales was 100, my rental was 11. Because I sell 200, will I pay 22 as rent? Answer is no. My rent will continue to remain 11. Or what I'm trying to tell you is, if you start studying all your heads of expenses nature-wise, you will discover against certain heads, you will be able to write either the letter V for variable. Against other heads, you'll be able to write F for fixed. Folks, all your costs can be broken up nature-wise into 2 types, variable costs and fixed costs. And of course, there's a category called semi-variable, semi-fixed, where you can segregate the variable component and add it to variable and add the fixed component to fixed. Now, when I tell you my sales is 100, cost is 80, profit is 20, sales is 200, guess the profit. You should tell me, Anil, if you want me to guess the profit, first give me the breakup of that 80. How much of 80 is V and how much of 80 is F? And only if I had told you, you know, the breakup looks like this. All 80 V, no F. Only then, folks, which is not going to happen. Only then, when sales of 100 becomes 200, variable 80 will become 160 and profit will become 40. But what if your breakup of cost was like this, 60 variable, 20 fixed? Now can you guess the profit? Not difficult. If sales of 100 becomes 200, variable 60 will become 120, fixed 20 will remain 20 and profit will become 60. And what if the breakup was like this? And if it was like this? And only if the breakup was like this, which is not going to happen. question I want to ask all of you. Tell me, when do organizations make more profit? When the fixed costs that they have to bear are less, or fixed costs are more? Lower the fixed costs, higher the profit, or higher the fixed costs, higher the profit? Can I see some answers? Lower the fixed cost. Lower. Uniformly, you are saying lower the fixed cost. Whenever I ask a question in finance, when I get the answer, my next question is, have you given me a common sense answer, or have you given me an accounting answer? Folks, you have given me a common sense answer. Fixed cost has to be low. How can higher fixed cost lead to profit? What does accounts say? Tell me in case one, where the variable cost was 80 and no fixed cost, when sales of 100 became 200, profit of 20 became 40. But when the fixed cost was 20, profit went up to 60. When the fixed cost was 40, profit became 80. In the last column, where the fixed cost was the highest, jump in profit was the highest. Lower the fixed cost, higher the profit, or higher the fixed cost, higher the profit? Folks, higher the fixed cost, higher the profit. But when I ask you, have you given me a common sense answer or accounting answer? I say yours is a common sense answer. And my next answer is, folks, if you have a conflict between common sense and accounting, please trust common sense. Common sense will always be right. Your common sense tells you lower the fixed cost, higher the profit. How do I mean higher the fixed cost, higher the profit? Am I suggesting that tomorrow you should shoot out a memo and tell all your employees, I'm doubling your salary because we were told higher the fixed cost, higher the profit? Don't do that. Profit will fall. Is it my suggestion that you ring up your banker and ask him, how much interest are you charging me on the loan? Only 10%? Can I pay 15% because I want a higher fixed cost? Don't do that. All common sense thinking tells you lower the fixed cost, higher the profit. Then how do I mean higher the fixed cost, higher the profit? Folks, imagine these are 5 different companies. The extreme right columns are 5 different companies. First one is A, second is B, C, D, and E. Last year, imagine all 5 had a P&L like column number 1, which has year 1 written on it. All 5 had sales of 100, cost of 80, profit of 20. But what was the difference between the 5? The difference between the 5 was the breakup of the cost. In case of A, 80 was made up of all variable, no fixed. In the case of B, it was 60-20, C 40-40, 20-80, and E 0 and 80. Between A, B, C, D, and E, who has the least fixed cost? A. Who has the highest fixed cost? E. Next year, all 5 of them worked twice as hard, and all 5 of them doubled the turnover. Folks, when A's turnover doubled, his profit also doubled. When B's turnover doubled, profit trebled. When C's turnover doubled, profit quadrupled, D's profit quintupled, E's profit went up the most. Between A, B, C, D, and E, who has the highest fixed cost? E. Whose profit went up the most? E's. Moral of the story, higher the fixed cost, higher the profit. Then why am I saying don't ring up your landlord? How much rent are you charging me? Can I pay some more? Don't do that. Common sense thinking tells you lower the fixed cost, higher the profit. How do I mean higher the fixed cost, higher the profit? Tell me between A, B, C, D, and E, who has the least fixed cost? A. Who has the highest fixed cost? E. But have you noticed? The cost of all 5 is 80. E doesn't have a higher cost. E has a higher fixed cost. Folks, if you unilaterally announce a raise in salary or hike in rent, your cost will go up, your profit will come down. Cost should not go up. Fixed cost should go up. Now, how can fixed cost go up and cost not go up? That can only happen if you start exchanging, if you start swapping what was a variable cost with a fixed cost. Now, folks, first of all, let me give you a graphical presentation. Many of you might be technical people by background. Graphical will make a little more sense. Tell me, if I present it in the form of a graph, what will a graph look like if you have no fixed cost? Folks, if all your costs are variable cost, the graph will look like this. If your sales goes up, your cost will go up in the same proportion. Your profit will go up in the same proportion. 3 linear lines. Here, if I had asked you 100 sales, 20 profit, 200 sales, 40. When will profit go up proportionately? When all your costs are variable. In such cases, if sales went up 10%, profit will go up 10%. If sales goes up 100%, profit will go up 100%. But what happens when there is a fixed cost in your costing structure? What does the graph look like? A fixed cost graph looks like this. Fixed costs don't remain fixed forever. Fixed costs also change, but when they increase with a jerk. So it's a step graph. But in this phase, while the fixed cost is not increasing, in the initial phases of a business, if you have a higher fixed cost, there will also be times where your sales revenue doesn't even cover your fixed cost. That is the phase where a business makes a loss. But as your sales revenue starts rising, soon you reach a point called the break-even point. Beyond the break-even point, if your income continues to rise, but your cost being fixed doesn't rise, this gap between income and cost becomes wider and wider and wider. This in finance has been given a name. This in finance is called the leverage effect. Folks, leverage is a fascinating area of finance. Unfortunately, I won't have the time to discuss it today. It's a fascinating area. It gives you so much insight that I can't tell you right now. But right now, all I want you to remember, what is leverage? People, the world interprets leverage in a very narrow way. The word leverage is only meant to indicate companies that borrow a lot. Folks, leverage is a far wider word. Right now, I'm telling you, leverage denotes a disproportionate impact on the bottom line due to a certain change in top line. If top line goes up 10%, bottom line can go up 20%, 30%, 40%. The higher the leverage, the greater the impact on the bottom line. And I'm saying if you want to enjoy the benefit of leverage, you need fixed cost. In the left graph, there is no fixed cost, so there is no leverage. To double your profit, you have to double your turnover. The fellow on the right, to double his profit, he can do it by increasing turnover 20-30%. Or if the right fellow also doubles the turnover, his profit will go up 4 times, 5 times. Now, this session is about cost management strategies for difficult times. Now, this works both ways. When will you exchange a variable cost with a fixed cost? That is a strategy for happy days. Happy days means market is booming. Lots of businesses there for the taking. When the market is booming, folks, wherever possible, exchange a variable cost with a fixed cost. Why should you do that? What is the beauty of fixed cost? Beauty of fixed cost is when sales goes up, cost doesn't go up. Gap between income and cost becomes wider and wider. What is the problem of fixed cost? Problem of fixed cost is, what if sales, instead of rising, starts dropping? When sales drop, costs don't drop, and profits come galloping downwards equally fast. Right now, we are facing tough times, folks. This COVID pandemic is going to create huge problems in the days to come. And therefore, in happy days, your strategy has to be, wherever possible, exchange a variable cost with a fixed cost. The moment situation becomes tough, wherever possible, exchange a fixed cost with a variable cost. You will probably get the best of both worlds. So question is, which variable can be exchanged with fixed and vice versa? All cannot. For example, your raw material can never ever become a fixed cost. It will always remain a variable cost. But folks, next time you want to make a new product and there is an internal debate going on, should we make this product in-house or should we outsource it? One of the arguments to be taken into account is, if you make the product in-house, there will be an element of fixed cost. If you outsource it, it is purely variable. If the market is booming and there is lots of business to be taken, and what you need is a team of live wire salespeople, and you are planning a recruitment campaign, and you are trying to figure out, how do I reward these new recruits in terms of salary versus incentive? Should we pay them a higher salary and a lower incentive, or a lower salary and a higher incentive? I want you to remember, salary is a fixed cost, incentive is a variable cost. Folks, if the market is booming, maybe you need to study your industry. Find out in your industry which company pays the highest salary, and then come out with the recruitment advertisement offering a salary which is ridiculously high, 50, 60, 100% higher than the highest paying company, but you say we are giving no incentive. What will happen if you offer a salary as ridiculously high as 100% more than the highest paying company? The best talent of industry will come and join you. This best talent will take the sales graph moving upwards, but it has come accompanied by a fixed cost. It is a genuinely win-win situation. You are planning an expansion. You are figuring out where will the next tranche of money come from. You have two choices. You can either approach a financial institution and take a loan, or you can raise money by way of equity, either put in your own equity or make a public issue of shares. I want you to understand, if you raise money by way of debt, the cost is called interest. If you raise money by way of equity, the cost is called dividend. One of them is fixed, one of them is variable. Which one is fixed? Interest. Which one is variable? Dividend. Folks, I am trying to tell you, in happy days, if you have to choose between in-house and outsourcing, maybe in-house makes more sense, but in tough days, you should go in for outsourcing. In happy days, when business is booming, when you have to hire sales teams, probably it makes sense to give more salary and a lower incentive, because once they have brought in enough business to recover the salary, thereafter only income comes in, there is no cost. But in tough days, switch everybody if possible, or whoever possible, to variable costs. So that if they bring business, they get. If they don't bring, they're not a burden on you. I am saying in happy days, your expansion can be funded by debt, but in tough days, preferably fund your expansion by way of equity. Now keep this at the back of your mind. Jatin, you said no VC in this chart, because this chart, Jatin, is given with half-baked information. I was only trying to explain the relevance of fixed cost. You are absolutely right. There has to be a total cost graph over there. It is intentionally not done. Okay. Now, folks, with this in mind, tell me, how do you arrive at profit? What is the formula for profit? Usual formula for profit is sales or income minus expenses. But I have now told you your expenses can be broken up into two, variable and fixed. In fact, right now I'm urging all of you. You normally receive your data in the form of a P&L, which has got sales on one side and numerous heads of expenses on the other side. Folks, you will never be able to make sense. I am urging you to represent that data and reduce all your expenses nature-wise into VC and FC. It's not easy, as easy I'm making it sound, but it is doable. And if you do that, now what is the revised formula for profit? Profit becomes sales less variable cost, less fixed cost is equal to profit. Let's take some example. Let's say this company, let's take an easy example. This company manufactures furniture. Can you give me the most obvious variable cost in the manufacture of furniture? Let's say wood. Let's assume this company consumes 100 dirham worth of wood per table. Give me one example of fixed cost. Let's say they hire a shed to manufacture the tables in, and they pay 10,000 dirhams as rent. Now, folks, let's imagine this company makes only one table. What does one table cost this company? Variable cost of one table is 100, and the entire rent will have to be borne by the single table, and therefore a table will cost them 10,100. And if this company wants to make a profit, they will have to sell this table for greater than 10,100. Then they realize selling price is not in our control. Selling price is dictated by market, by competition. And let's imagine all their competitors are selling tables similar to theirs for, let's say, 250 dirhams. Now, this entrepreneur realizes I will also have to price my table at max 250, maybe less, but not more. So he also prices it at 250. I said we have to learn how to look at top line and understand bottom line. One of the simplest and easiest thing I'm suggesting is get your data submitted to you in the form of VC and FC. And now you realize profit becomes a function of sales, less VC, less FC is profit. However, sales minus VC has also been given a name. I hope you're familiar with that word. If you're not familiar with that word, then I will urge you to familiarize yourselves as early as possible, because it is perhaps the most important word in the costing lexicon. And that word starts with C. Folks, sales minus variable cost is called contribution. And contribution minus fixed cost is called profit. Neil, you're absolutely right. It's called contribution. So what's the formula for profit? Profit is sales less VC is equal to contribution less FC is equal to profit. Can you help me complete the table, please? Sales of one table is 250. Variable cost of one table is 100. So contribution will be 150 less fixed cost of 10,000. This company's bottom line is negative 9850. They are making a loss. So this entrepreneur comes to you for advice. Please tell me, what do I do? My business is making a loss. What advice will you give him? Obvious advice is, you're making a loss because you're selling one table. Please make and sell more. This fellow listens to you, doubles the output. Now let's fill the table. Sales becomes, oops, I don't know why this happens. Sometimes. So they make the second table. Sales will become 500. Variable cost will become 200. Contribution will be 300. Fixed cost is still 10,000. And the loss reduces to 9700. So they take a quantum leap and make 10 tables. Sales, VC, contribution, FC, still loss. By now, this person is beginning to get fed up. He says, I want to know, when am I going to break even? Folks, I want you to watch this table carefully and help me devise a formula for break-even point. I can give you the formula in a second, but you'll forget it by tomorrow. If you're instrumental in creating it, it will stay with you longer. When will this company break even? Why are they making a loss? Look at table one, number one table's numbers. Why are they making a loss? Because sales is 250, VC is 100, contribution is 150, FC is 10,000. They are making a loss because the figure of contribution is smaller than the figure of fixed cost. But as the quantity starts rising, sales is rising, VC is rising, contribution is rising, FC is not rising. Folks, table by table, they start narrowing the gap. It is not difficult to visualize that as the quantity goes on rising, the contribution figure will go on rising. A stage will come where contribution is 10,000, fixed cost is 10,000. That's the break-even point. Or I'm telling you, till such time an organization's contribution is lesser than the fixed cost, organizations make a loss. The point where contribution equals the fixed cost is the break-even point. Where contribution exceeds the fixed cost is where you make a profit. You see what an important word contribution is? So what is the condition necessary to break even? Contribution should be equal to fixed cost. How much is the fixed cost of this company? 10,000. How much is the contribution generated by one table? 150. How many tables should they make in order to generate a contribution of 10,000? What divided by what? 10,000 divided by 150. What is 10,000? 10,000 is fixed cost. What is 150? It is contribution per unit. So what's the formula for break-even point? Fixed cost divided by contribution per unit. It works out to 66.66. So this company decides to make 66 tables. Sales of 66 tables becomes how much? 16.5. Variable cost of 66 tables? 6,600. Contribution, 9,900. Fixed cost, 10,000. Still loss. Why loss? Because the break-even was 66.66. So this person makes the 67th table. Sales, VC, contribution, FC, they make a profit. And if they make the 68th table, sales, VC, contribution, FC, profit. Question I want to ask all of you, can you please tell me, why is contribution called contribution? The word contribution tells you it contributes to something. But every table sold by this person contributes to the company's cash box a 250. Why don't we say 250 is contribution? You might say, Anil, how can you call 250 as contribution? 250 is gross revenue. To earn 250, this fellow has to spend money. Fair enough. Then minus what he has spent. If you can't call the top line as contribution, deduct the expenses and call the bottom line as contribution. But folks, neither the top line nor the bottom line. And in between line is called contribution. What is this a contribution towards? Why is contribution called contribution? And the answer is, tell me, what was the bottom line when this company made one table? Bottom line was 9850 negative. Then they made the second table. What is the bottom line? The loss reduced to 9700. How much did the loss reduce by? Because they made the second table, that is 150. See, that is contribution. What is the profit of 67 tables? 50. How much is the profit of 68 tables? 200. How much did the profit increase by? Because they made the 68th table, again 150. Folks, are you noticing at any point, impact on the bottom line is equal to contribution? I want you to notice something. Bottom line is impacted to the extent of contribution. So contribution is called contribution because this is the contribution of every unit made and sold to the organization's bottom line. All of you should know your organization's contribution. If you're selling electronics, you should know contribution per unit sold. If you're a builder making buildings, you should know contribution per square foot. If you're running a restaurant, you should know contribution per masala dosa sold, per pizza sold, and so on. How much is the break-even point of this company? 67. Imagine this company has got a fantastic sales team. And very, very soon, they have broken even. Their break-even is 67. They have gone and sold 100 tables. Let's work out the profitability of 100 tables. Left column is quantity, right column is amount. So when they sold one table, your left column is per unit. Selling price per unit 250, 100 tables sold. What is the sales? 25,000. Variable cost per unit is 100. Total variable cost is 10,000. How much is the fixed cost? 10,000. Now 10,000 is the fixed cost of 100 tables. So how much is the effective fixed cost per table? Again 100. So what does a table cost this company? A table costs this company 200, or 100 tables cost them 20,000. Folks, this company makes a table for 200, sells it for 250. Every table sold makes a profit of 50. They have sold 100 tables, made a profit of 50 per table. So the bottom line of the company is 5,000. Kishore has a question. What if you are making 1,000 different types of products? Then Kishore, you will have to put them in buckets. All products with a certain kind of contribution in one bucket. So maybe your organization will have half a dozen buckets. The 1,000 products can be broken up. This bunch of product has a 30% contribution. This bunch of product and so on and so forth, right? Okay. Folks, is this clear? How much does a table cost this company? 200. How much are they selling it in the market for? 250. How much is the profit per table? 50. How many tables sold? 100. So what is the bottom line? 5,000. It could be 5,000. It could be 5 million. It could be 500 million. Whatever. Early morning, this entrepreneur, this owner calls a sales meeting. Gathers all his sales guys in a room and says, I have good news for you. He informs his salespeople, you are aware we are a relatively new table manufacturing company. You guys are also aware our break-even point is 67. He said, I'm very happy to inform you people, because you sales fellows have done such a wonderful job. He says, in a short period of time, our company has broken even. Our break-even is 67. You guys have sold 100 tables. He said, let me share with you the profitability result of 100 tables. He tells his sales team, we as an organization manufacture a table at an in-house cost of 200. You guys are selling it in the market for 250. Every table sold by you, the company makes a profit of 50, and you sold 100 tables at 50 each. Company's bottom line is 5,000. Now he tells the sales guys, two jobs in front of you. Job number one, go out into the field and carry on doing the good work that you're doing. And he says, job number two, I'm going to borrow some names from here. Let's say I can see Neil. He says, job number two, Neil is a competitor. He tells his sales guys, see that business comes to us, doesn't go to competition. How will you do that? Let's say you bump into Manoj Saxena. Manoj is a potential customer. And Manoj asks you for a quotation. How much will you quote him? Obviously 250. But Neil is also in the field. And Neil tells Manoj, I can give you a similar table for 240. Then this entrepreneur tells his sales guys, don't watch Neil take the order away. If Neil gives a discount, you also give a discount. But he warns them, don't give so much discount that I make a loss. I'm not that desperate to deny orders to competition. But so long as we don't make a loss, I am empowering you to play around with prices. Guys, tell me, are the instructions clear? What instructions have been given? Instructions given are, go out into the field, as far as possible, sell my tables at the stipulated selling price of 250. However, if circumstances demand, give a concession, but don't give so much concession that we make a loss. Is everyone okay? Just give me a thumbs up. Just give me a yes or no. I'm a little faster than usual, but intentionally, so that I can take you to a logical end before I have to end the session. Thank you. Thank you so much. Wonderful. Wonderful. So his guys go out into the field. They bump into Manoj Saxena. And Manoj says, how much is your table for? Our salesman quotes 250, but Neil's guys are also there. And they said, we will give you a similar table for 240. What do you recommend our salesperson to do? Can our sales guy afford to say 230? This guy says 230, Neil's salesman says 220. Can our fellow say 210? Neil says 205. Can our fellow say 202? Neil says 200. Now, if you want the order, our fellow will have to go below 200. What should he do? Should he go below 200 and take the order? Or should he say, Neil, now you keep it? Or let us say at this stage, Manoj interrupts. Manoj says, both of you, please don't argue. My budget is 150, whoever wants to take it. Now, folks, what decision? No, Savio, not more tables. This is a single table. Manoj is buying a table, is a dining table to eat food on. He doesn't want to buy more. So what decision does this salesperson have to take standing in the field? Decision to be taken is, should I say yes to Manoj or no? Folks, I have a definition of finance management. I've always said finance management is not what happens in finance department alone. Finance management is the ability on the part of every individual to understand the impact on the bottom line of every action of yours. By your action, if the company's bottom line becomes stronger, do it. If it gets hurt, don't do it. Do you appreciate this salesman standing in the field must understand, if I say yes to Manoj at 150, will my company's bottom line become stronger or weaker? If it becomes stronger, say yes. If it becomes weaker, say no. So let's find out. If you say yes, what will happen? Folks, the next table is sold at 150. So 25,000 will become 25,150. Not important. What is important is, what will it do to the bottom line? What is the existing bottom line? Existing bottom line is 5,000. And why is it 5,000? Because this company makes a table for 200, sells it for 250. Every table sold make a profit of 50. 100 tables sold at 50 profit each. Bottom line is 5,000. Now, what about the 101st table? Folks, when you sell a 200 table for 250, you earn 50. Now a 200 table has been sold for 150. How much did you lose on one table? On one table, you have lost 50. On 100 tables, you earned 5,000. On one table, you lost 50. What is the bottom line of 101 tables? It looks like it should become 4,950. Has the bottom line become stronger or weaker? It looks like it has become weaker. Should we say yes to Manoj or no? Let's find out. New sales 25,150. New VC is 10,100. New FC is still 10,000. New total cost is 20,100 and new profit, it is not 4950, it has become 5050. Folks, you made a profit. How? A table that cost you 200, you sold for 150 and you made a profit. How did that happen? This is where the concept of contribution comes in. What formula did I give you for contribution? Selling price minus VC. How much did you sell this table to Manoj for? 150. How much is the VC? 100. On Manoj's order, did you generate a positive contribution or negative contribution? You generated a positive contribution of 50. My second question to you was, why is contribution called contribution? And I said it is called contribution because it contributes straight to the bottom line. Folks, old bottom line was 5,000. Manoj's contribution is 50. New bottom line is 5050. Can any salesperson afford to say, I don't need to understand this? I'm a non-finance person. Folks, this is exactly what your job is. But the question still remains, how can you make a table for 200, sell for 150 and make a profit? How did it happen? Is it because this company has broken even? As Muthu Krishna says, they have already covered the fixed cost. What happens at break-even point? Break-even point is the point where you have recovered not only the variable cost, but the lump sum fixed cost also. Beyond break-even point, no more fixed cost to be recovered. Who is Manoj? Is he your only customer or is he your marginal customer? Marginal means additional. This topic is under marginal costing. Folks, Manoj is the marginal customer. So long as the marginal customer pays you more than the marginal cost, which is the variable cost, and leaves behind a positive contribution, you cannot go wrong. But would this logic have worked had the company not broken even? Would this logic have worked? Let's imagine they're not broken even. How much is the break even of this company? 67. They are selling 50 tables. Sales of 50 tables at the rate of 250 is 12,500. Variable cost of 50 at the rate of 100 is 5,000. Fixed cost is still 10,000. But now 10,000 is the fixed cost of 50 tables. So how much is the effective fixed cost per table? 200. What's the scenario today? Folks, scenario today is this company makes a table at an in-house cost of 300. They make it for 300. Due to competition, they are forced to sell it at 250. Every table sold, they lose 50. They have sold 50 tables, lost 50 per table. Bottom line of the company is negative 2500. Is this clear, folks? How much do they make a table for? 300. How much do they sell it for? 250. How much do they lose per table? 50. How many tables sold? 50. Lost 50 per table. Bottom line, 2,500 negative. Under these circumstances, this company's salesperson bumps into Manoj and Manoj says, you know, I am very, very keen to purchase a table from you, but I have budgetary constraints, cannot go beyond 150, take it or leave it. Now, should this fellow take it or leave it? Logic is the same. Logic is ability to understand impact on the bottom line of every action of yours. By your action, if the bottom line becomes stronger, say yes. If it becomes weaker, say no. So if you say yes, what will happen? Top line, next table sold at 150. So 12,500 will become 12,650. Not important. Question is, what will it do to the bottom line? What is the existing bottom line? 2,500 negative. Why is it 2,500 negative? Because a table that costs you 300, you're selling for 250. Loss per table, 50. You sold 50 tables, lost 50 per table. Bottom line, negative 2,500. 50 first table. Folks, when a 300 rupee table is sold for 250, you're losing 50. Now a 300 table is sold for 150. Now how much did you lose on one table? 150. So what is the new loss? 2,650. Has the loss increased or decreased? Looks like it has increased. Should you say yes to Manoj or no? Let's find out. New sales 12,650. New VC 5,100. New FC 10,000. New total cost 15,100. New bottom line, oh, loss did not increase, it came down. Again, you have made a profit. Now, how did you do that? Last time you told me they could do it because they had broken even. This time they haven't even broken even. Now, Muthu Krishna, how did it happen this time? Folks, I don't remember telling you at any stage that contribution is called contribution after break even. Did I ever say that? Contribution is contribution, period. What does contribution mean? Contribution means if you're making profit, the impact, profit goes up to the extent of contribution. If you're making losses, losses go down to the extent of contribution. Can any salesperson afford to say, I don't need to understand this? Expand the numbers a bit. Imagine the sales is not 12,200, it's maybe 12,500. Let's say it is 125 crores. Most of you are in Dubai, but I think most of you are Indian, so crores, I hope it makes sense. Or I can say millions, 125 million. The cost is 150 million. This company is losing 25 million. They're bleeding. Every morning, this entrepreneur gets up and gives a pep talk to his sales guys. Gentlemen, desperate situation. Company is bleeding. We are losing money. Go out, find customers. We are desperate for orders. If you don't bring orders, it's a no-win situation. This company will probably shut down. You guys will lose your jobs. Everybody will suffer. His guys go out hunting for customers. Now here is Manoj walking up to him. I want to buy a table from you, but I can't give beyond 150. What's a typical reaction of the salesperson who often proudly says, I'm a non-finance person? His reaction will be, Manoj, how can I give you at 150? When I'm selling at 250, we are on the verge of shutting down. If I sell you at 150, I'll only hasten the demise of this company. Have you seen what a crime the salesperson has committed against the company? Had you accepted Manoj's order, where you were losing 25 million, you'd now be losing 24.5 million. Maybe you're not able to find customers because you are insisting on a price of 250. Maybe if you start accepting orders at 150, you might find more customers. You might say, Anil, if I accept everybody's orders at 150, my break-even will no longer be 67. It might become 110. But did you explore? Maybe it is easier to find orders for 110 tables at the new selling price of 150 than it is to find orders for 67 at the old selling price of 250. This is also part of your strategizing. Guys, remember, this is pricing for tough days, not happy days. In happy days, if Manoj said 249, say, Manoj, not interested. What do you mean by happy days? Happy days are when your installed capacity is 10,000 tables and your order book is 15,000 tables. But folks, your installed capacity is 10,000 and you're making 2,000 tables. You're paying your worker 8-hour wages and the worker is busy for 1.5 hours a day. Under such circumstances, saying no to somebody like Manoj is an absolutely criminal act, and it is probably suicidal act. Am I making sense? Questions, if any? This is cost management strategies for tough days. Let me give you a quick example just in case certain things may not have gone through. Imagine you're running an airline. You have a flight just now. It's going to take off from Pune to Delhi. Why Pune? Because I live in Pune, so example given is Pune. Your flight is about to take off from Pune to Delhi. You have a 100-seater aircraft. You have just now filled fuel in that aircraft for 500,000. What is your fuel cost? 500,000. How many seater aircraft? 100. So what is your per seat fuel cost? 5,000. Let's say you spend another 200-300 per passenger on food, etc. What does a seat cost you? 5,300. You decide we will price a Pune-Delhi ticket at 9,000. Flight is about to take off. 100 people are not sitting. 50 people are sitting in the aircraft. One person comes running up the runway, last minute, bag in hand. Please take me also. But I cannot pay 9,000. What is the least you can charge this person? Tell me, how much discount can we give him? What is the minimum we can charge him? He says, I can't pay 9,000. If you give me less price, I'll take it. How much can you charge him? Minimum. 5,300. This person says, I can't pay 9,000. I can afford to pay 1,500. Should we take him on or no? Grab him. Don't let him go. This is marginal costing, folks. Normal thinking tells you don't go below 5,300. Marginal costing says your cost is not 5,300. Your fixed cost is not 5,000. Your fixed cost is 500,000. You did not fill fuel of 5,000 for him. Fuel is already filled. It's a sunk cost. As it is, you're flying with 50 people, probably you're already making a loss. If you refuse him, that 1,500 that will come into your kitty, even that will not come. So the best case scenario is, worst case scenario is your cost is 300. And 1,500 minus 300, 1,200 would be your contribution. The best case scenario is your cost is zero. Why? Because if you're a good airline and the 300 is made up of food, if you don't serve it, hopefully you'll throw it away. So whatever he gives, take it. It's a different story from him. You could have charged him 18,000. Why? He's come at the last minute. But what if this fellow says, take me on, otherwise 30 minutes later, another aircraft is going, I'm going there. Then don't let him go. This is cost management strategy for tough days. I'm sorry for the speed at which I went. I only wanted to bring it to a logical end. Now, even I think we are almost to the end of the time. Folks, thank you so much. Just before I wind up, we are planning this program in Dubai or for people from UAE called Financial Acumen for Leaders. Some details are given here. If you want, maybe you can take a screenshot, but Daksada will give you more details about it in the coming few days. In case this time, COVID time, one has time to spare also. And if you'd like to arm yourself with more finance management understanding, we have this program coming up. You'll soon receive more information from Daksada about this. Thank you very much, folks. Thanks a lot. Wonderful, kind comments you're giving. I thoroughly enjoyed, even though it was a one-way interaction, but you guys were constantly giving feedback through the chat box. I appreciate that. Hari, all yours.
Anil, thank you. As always, I think this has been one of those brilliant sessions that we have seen coming across from our potential partners. I'm sure everyone in this forum would have loved it. I would like to thank you for even having agreed beside your busy schedule for this particular webinar today. I would like to thank participants from India and from Singapore who have joined us today. I'm hoping you have enjoyed this particular program. We plan to have, we'll have this session of yours being sent across to everyone, those who have missed it. You could also share this with your colleagues and friends. I think it's going to help everyone who's in business today. Secondly, I would like to let you know that, as we said at the start, this is one of the top 3 Leadership Insight webinars that we are hosting. We'll send you the link for the next one that's going to be on driving sales in times like these. So that's going to happen on next Tuesday, same time. I look forward to having all of you all with us here. And once again, thank you for making this session as participative as possible. I see the message box, with everybody talking about how they've enjoyed the session. Anil, once again, a very big thank you, and looking forward to seeing you soon in Dubai post-COVID.
Yes.
Thank you.
Thank you. Thank you, everybody.
Thank you.